everyone. My name is Luis Alejandro Lopez. I'm here with Hector Hernandez, and this is a real life real estate show. So we're gonna bring you an amazing state-of-the-art, information. We got a really amazing show about syndications. We're gonna go to the update on the markets, and we got plenty awesome information for you guys today.
Yes, sir. I am Hector Hernandez. I am a real estate fund manager and wealth building coach here at reallifetrading.com. If you have not already done so and you're watching this recording, please go ahead and hit like and subscribe to the channel. It's the only way you hear the greatness that we have to say. And more importantly, it makes us feel good about ourselves. Before we go too far, Luis, can you pop that very important slide on the screen, please? Please remember that we are just two random guys on the internet, and absolutely everything we talk about here today is for entertainment purposes only. Real estate investing, just like all types of investing, has risk. Please know what you're doing when you are doing it. Don't say we told you how to do it. What do you got for us, Luis? How is Jay Payne destroying the market this week? The real estate market, that is, besides the stock market that's already taking a massive
all right, we went through that last month. All right, so here's what happened. Jay Powell raised the interest rate, as we all saw last week. Okay, another 3/4 of a point, third time in a row that he raised the interest rate. But furthermore, they already said it over and over, they're looking for a 2% inflation rate. They're not going to stop. They're going to put us on pain. They're going to make our life miserable until the inflation is at 2%. Okay. The existing home sales, I just picked up this from National Association of Realtors. Existing home sales just fell, 0.4% from July to August. We still don't have the numbers from September. September is going to be next month. We're not going to see anything in these numbers. Do not reflect that last increase from the interest rate. We're going to see that next month. Okay. The pending homes also fell, 2% month to month from July to August, and it's 24% year to year, meaning that, yeah, things are slowing down. Prices are still there. Prices are still, the going up is not really going up. Things are leveling up. I have not seen major droppage in some of the markets. Okay, the markets we checked in Florida, we checked in Georgia. We have not seen major drops or anything. I don't expect major drops yet, but things are just going to be level up. Okay, and this is what is going to really make a difference. The average 30-year fixed mortgage is a 6.85%, double what it was a year ago. So this is really what's going to put, the handbrake and the emergency brake and home purchasing, and we're going to see that by November, December, is when, the snowball effect is going to start rolling in. Okay, so as of now, nobody's dying. We're not in panic mode. We're not going to die. Nobody's burning, but things are definitely slowing down. Okay, which is really what the Fed wants. So nothing we can do there, and just keep being patient, and opportunities are going to start showing up really soon. Okay, so let's see. We'll have an amazing class for you about syndication. Okay, type 1 in the chat if you're familiar with syndication, if you heard the term before, you're interested in investing with someone else, privately and passively.
Hey, actually, before we get off the topic of the market, Lou, I do want to, first and foremost, just say that our prayers and thoughts are with everyone in the Southwest region of Florida. Obviously, I am in Florida as well. I'm in the Southeast. I was extremely fortunate. We escaped the brunt of the hurricane. We do have one project that was like dead smack target for that massive hurricane. And there's been some damage. It's all property damage and financial damage, nothing that, affected us and our health and our family's health, thank God. There's a lot of people out there that I know that are hurting, and I'll be actually heading out to the area tomorrow to check in on our investments and help out wherever I can in the community, the neighbors. We have some amazing neighbors that have been helping us out, keeping us up to date with what's going on, and they've asked for help. So I'll be on my way tomorrow to lend a hand. if you're out on the West Coast, Richie, anybody watching this, you guys have my number, reach out. I'm happy to help out, bring whatever supplies you all need. This is a team effort.
Yes, sir. Absolutely. A lot of people lost a lot of stuff. So, what can we do just besides help, really?
Exactly. Terrence says, do I need help? Man, I need all kinds of help, and not just in, physical help, mental. I mean, no, but I'm actually gonna be out there for a few days. I think I'm gonna be helping out my in-laws and stuff. So I'm not really sure what the schedule looks like yet, but I do know that I am leaving tomorrow morning. All right, Lou, bring on the magic.
Yeah, maybe another pair of hands will work for
It
sure.
always.
I'm sure there's a lot of debris and stuff to try to clean and help people.
I can't imagine that there is, and based on what we've seen, I mean, hopefully I'm even able to get to the target area, because from what I hear, there's still a lot of flooding. National Guard is out there, so we'll see.
Yeah, basically Fort Myers Beach is basically blocked out for everybody.
Yeah.
And we are 20 minutes away from there.
Captiva Island it's essentially inaccessible. The bridge just disintegrated. So it's pretty bad. It's pretty sad for the folks out there. So we'll see what I find and what I can do. Yes.
All right.
Exactly. I'm definitely gonna wear my RL shirt. Yes, Cindy. Absolutely. I will be flashing the RL badge. All right. So that brings us to the amazing topic of the day. A lot of people have asked, a lot of people are curious, and it is becoming more and more popular. Luis, what is a syndication?
Syndication is basically a group formed with a common purpose, okay? But this term that we're going to talk about it in real estate is basically putting the financial resources to accomplish a goal. Everybody puts a little bit of money, gives it to a sponsor, and we go and buy a property, buy a business, or form something with a common goal to probably usually is make money. For example, banks will do that. Banks will syndicate large loans to other banks where they don't want to take the whole risk. Becomes a big project, the bank will get 2 or 3 another entities, and they between all of them will fund 20%, 10%, 15% will fund the big loan. Okay, usually business owners will syndicate the companies by selling a portion to private investors in order to expand it. Technically, that's what the stock is. The stock is that you buy a portion of the company. Okay, that's what we all do here. Real estate syndicates use these pool resources to expand their portfolio and get even more assets. Okay, usually you get 2 people or 2 partners on the syndication. You get the sponsors, which is general partner, which is the one that has the experience, has the project, found out everything. And then you have the passive investors, the limited partners. They just put the money and invest passively into whatever the sponsored business is. Okay. Another thing that we're gonna see here is that we're gonna see a whole bunch of terms. Okay, they are pretty much interchangeable. When you talk about real estate funds, you talk about real estate syndication, multifamily syndication, RV parks funds. Basically, they're all the same. The difference is going to be the way they're set up. You can have syndication for everything. Basically, you got a business, you got an idea, you need investors' money, you syndicate that idea, and you share shares of your property. In this case, we're going to talk real estate, and has a few different rules than for a regular business. The other thing that we're going to say is that syndication is the best way to increase your wealth, because it's been basically since the beginning of time. It's better to work with OPM, other people's money. If you pool those resources, you can expand your business exponentially. So instead of, let's say, we're doing real estate and you're doing a condo at a time, if you get money for investors, you can buy, a whole multifamily business. You can buy several single family homes, et cetera, et cetera. Okay. So these themes are the best secret in wealth creation. That's basically what it is. Okay. So let's talk. What is a private offering? Okay. Private offerings are investment opportunities that are not available in the stock market.
Hey, Lou, before
Simple
you
as
go too
that.
far in there, let me throw out a couple terms because I know they're a little boring, but we're going to be mentioning them interchangeably, and I want to make sure that everybody can keep up. The person who puts the syndication together is called a sponsor, a manager, a promoter, a syndicator, or a general partner. Or if the law, aka the SEC, is the one naming you, they call you the issuer because you're the one issuing the security. So just make sure that while we're going back and forth and we're throwing these names out there, I want to make sure that everybody can keep up. They're all used interchangeably depending on who you talk to. The other side of that equation, like Luis said, is the capital partners, right? The investors who come in on a limited basis. Their job is to put up cash so that the business plan can move forward. They are called LPs, investors, and a few other names. But we're going to stick to those for the most part in the presentation, is the LPs and investors. All right, sorry about that, brother. Go ahead. It is Gregory Hill asked, is this similar to a REIT? And yes, it kind of is in a way, sort of. REITs are more publicly traded, whereas most syndications, not all, there's some public syndications, are technically privately created. And that's why the next question is, Luis, what is a private offering?
All right, so what are private offerings? Like the name said, private offerings are investment opportunities that are not available through the regular markets. So regular public markets, they're not going to be advertised. Okay, like in the stock exchange, you can buy securities of everything you want, like a REIT. These investors, usually the sponsors will promote or will have a business model that they want to share, but they have to do it person to person. We're going to go through that in a little bit later. The syndicator, what we do is we usually set up a promissory note, or we will sell an interest on the company. Okay, both of those are considered securities, technically speaking. Okay, and so the process is called securities offering. Most of those securities are exempt from registration with the SEC. Everything that you see public that we can trade, that we can find online and is promoted, has to be registered with the SEC. Okay, these placements are usually made directly to investors. You cannot find them. You need some of them that will find you, but it's not something that you will find easily that you can just go click twice with your mouse and buy it. Okay, you need to go through a process. You need to find out what they are, et cetera, et cetera, et cetera. Okay, so they're the opposite of stocks or IPOs or SPACs. They're basically sold. You basically gonna open a company. I want to open for everybody to buy my company. You prepare an IPO and you launch it. So everybody, no matter who they are, can buy it. Usually in the private offerings, there are additional rules. Okay, so let's go over the 4 most common structures for real estate syndications. Okay.
All right. So there's 1,000,001 ways to syndicate, and there is 1,000,001 reasons to syndicate. Today, we're going to be focused on these 4 that you see here on the screen, and we're specifically going to relate them to real estate. Again, you can syndicate, like Luis said, to do just about any kind of business. We're only focused on real estate. That's where our expertise really lies.
All right.
So the 4 most common ones are specified offerings, blind pool funds, semi-specified offerings, and segregated offerings. There goes the man himself. Welcome, Mr. Newsom.
He's here.
Yes, I've been looking forward to this. So pumped.
Yeah, buddy.
How are you?
Doing great, guys. Doing great.
All right.
He's a syndicator himself.
What doesn't he do?
Yeah, exactly.
All right, so let's get to the digging. All right, let's go to the next slide, and let's discuss specifically the specified offering. And these are what you typically hear out there. For those of you who have heard about this, you'll hear them called syndications. You'll have a friend or a buddy that says, hey, I invested in a syndication, or hey, I'm going to create a syndication for this multifamily apartment building that I'm buying. And that's why most people say, oh, it's a syndication. Well, the term can be used interchangeably. At the end of the day, it matters that it is an identified offering. So typically these are going to be for those properties that have already been put on their contract or the sponsors looking to put on their contract. Like I said, an example of a general partner who's looking to buy an apartment complex, a mobile home park, or even a mini storage facility. And sometimes they want to also buy a development project. You already have the land, you have a business plan, so it's specified to that particular investment. You can do what's called a syndication of a specified offering. It doesn't really matter the kind of asset. As you can tell, I just ran through a bunch of different asset classes. The main point is that the property's already been identified and that the sponsor is selling off interest in that title holding company to investors, aka the limited partners, the LPs. It is the sponsors bring typically their experience, their knowledge, and they come with some sort of institutional financing as well for a portion of that, and they seek the remainder capital to make the improvements for the down payment, for holding costs, for development from private investors, the limited partners. Sometimes if it's a development project, you'll see it take a little bit longer where they go full in cash, they start developing up until the point that they can take out a bank loan and pay back the investors a portion of that investment. For specified offerings, you're typically going to see a property information package that the sponsors put out. And this property information package is going to have all the meat and potatoes. What is the description of the property that they're trying to buy? Where is it at? What are the demographics in that area? And most importantly, what are the projected returns and the time frame for which your capital is going to be tied up? This is usually called the pro forma. Some investors really love this model because they have the ability to know what they're getting into, what the asset is that they're going to be buying into essentially, and they can underwrite the property or the project on their own prior to investing. Obviously, this means that that particular investor would have to be familiar with underwriting that type of asset. Not all investors are that familiar with underwriting, particularly with certain of these very complicated asset classes. Because of this fact that you're already telling the sponsor, hey, I'm going to buy this particular asset right here, a lot of sponsors like this model because it makes it easier on them to raise the capital. It's not a surprise to the investor, and a lot of investors could get behind that model. The challenge here is, though, you've already identified that property. 90% of the time, you've already put that property or those properties under contract. And so now you have to run out and raise the capital needed within the 30 or 90 days that the seller's giving you to close. Particularly in a competitive real estate market, it gets pretty tough. So a lot of these guys are very experienced people who have already been doing this and already have a nice Rolodex of investors. Otherwise, they might get stuck without being able to raise that capital.
Yeah, it's very easy to, go to an investor and say, listen, I'm buying that building right there. And they can go, they can show it, they can show you the pro forma, they can show you how it's performing, if it's making money, if it's not making money. But again, if you don't have a good Rolex, like Hector said, then what happens is that you go into a contract and then you need to start, busting out to get people to, randomly, hey, do you want to invest here? Hey, do you want to invest there? You want to invest there? So this is great for people that already started and they already have a good connection. So they can just pick up the phone and boom, 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 raise whatever amount they need. It's done, it's set up.
And there's many ways of doing that. This is not a capital raising class by any means, so we're not going to get super deep into all that. Woodshed Williams in the chat says that you usually do have to have a personal relationship with the sponsor or the syndicator. And that is true for some models, not all models. We're going to cover that a little bit later. But that is typically one of the best ways of doing it. Plus, we'll get to why later. You want to have a relationship. You want to know who you're investing with. Exactly. They're basically managing your investments. So you want to make sure they're capable individuals. The next one that we have is blind pool fund. And that is one technical legal name. But out on the street, when you're talking to investors, when you're networking, 98% of the time, people just say real estate fund. Hey, I invested in a real estate fund. Hey, my buddy has this real estate fund that he's buying medical offices with, or they're buying single family homes, whatever the case may be. In this particular scenario, your sponsor is raising capital from investors prior to any property being identified. So these funds are all pulled together in a single entity that goes out and acquires, most of the time, multiple assets. Since this fund or company will own multiple assets, it makes it very, very risk friendly to a lot of investors. So some investors really prefer this model because it provides a way to diversify within that fund. Sometimes that fund is invested in multiple properties in the same location or multiple properties in different locations. So you have geographic diversification, or in multiple asset classes. You might have a fund that, you know, there are all kinds of setups out there, right? But you might have a 50% single family, 50% multifamily, or 50% multifamily, 50% storage facility. And that just provides diversification. The most important thing that you're going to note here is that your sponsor is always going to provide a business plan, which is typically called an investment summary, right? And in this investment summary is where it's outlined exactly what it is that the fund will be doing. And unless it is voted upon by all the members, including the LPs, that business plan, that investment summary may not change. So let's throw out a couple of examples. Investor decides, or a sponsor decides, they're going to create a fund to go out and buy tiny homes in Kentucky. And that is specifically their business plan. That's what they put on their summary. They cannot go to South Florida and start buying gas stations. They now have to have a vote from all the members to change that business plan. Does that make sense? If I'm going too fast or if something's not making sense, please guys, go ahead and fire it off in the chat and we'll absolutely address it. In this investment summary, like I said, is going to basically not only dictate the type of asset class and the business model that the company or the fund is going to deploy, but more importantly, is going to show you the underwriting criteria and the strategy that they're going to employ for the duration of the asset of the fund. I'm sorry, as well as the duration of the fund. You will typically find funds and syndicate and the specified syndications as well that are anywhere between 3 years to 7 or 10 years on the very long end. Very rarely do you see them go past 10 years. It is somewhere around the 3 to 7 years, the sweet spot for most investors. And so that's going to be outlined here in your investment summary. And the most important part is that exit strategy, right? How are they going to make you money, the investor? Typically, these funds are created, and all syndications, these businesses are created to deliver cash, to deliver returns to the LPs, the investors. In exchange for that return, the LPs put up money, and in exchange for that money, the GPs go out and do the hard work. They put their experience and their sweat equity on the line. So you want to, whenever you're evaluating a fund, you want to make sure you understand that exit strategy. How is this fund going to make you money? And these are typically referred to as the waterfall. And this is the same for both funds and syndications. We're going to do a different video on waterfalls because that's such a massive topic. I don't want to, that'll get pretty complicated real fast. There's a million and one ways of doing it. The main point that you need to understand here today is that it's just a fancy way of saying the profit sharing model. You know, I have no idea who came up with the term waterfall, but it basically means the way that they're going to share profits among all investors and the general partners. Let's throw out some examples that we all understand. We're all traders here. We all invest in the stock market and we understand hedge funds pretty well. I'm 99% sure you all know BlackRock. BlackRock is a fairly big hedge fund company, parent company for a bunch of different funds. I'm not even sure what they consider themselves at this point anymore because they got their hands in about like pretty much every cookie I've ever heard of. And so let's relate it to what we're talking about here, which is real estate. Obviously, we all know that they have different funds that invest in the stock market. But they also have a lot of funds that invest in mortgages. And the one that we all know, Invitation Homes, invest directly in real estate. They actually go out, they buy single family homes and rent them out. And they basically started this practice sometime,
2011, 2012.
I think it was like 2012, 2011, like dead smack in the mix of the worst real estate dump or real estate market that we've all seen in our lifetime. It was fairly brutal. Wall Street saw an opportunity. There was a lot of vacant properties. And they saw how much cash flow they could make to provide to the investors. They went out, they created these different funds. And I'm just picking on Invitation Homes because it's one of the more popular ones. But truthfully, there's hundreds of them out there. And a lot of them are owned by fairly large publicly traded corporations. And a lot of them are owned by smaller investors who basically go the private route to raise their capital, like we're talking about here. In the private fund community, right, the one that we're discussing here, sponsors or fund managers, as they like to call themselves, mostly will invest in various types of real estate assets, right? Some might invest in hard money loans, whereas BlackRock goes for the actual nice FHA mortgage. These guys, it makes a little bit better of a return to go for hard money loans, so they typically are able to sell that fund a little bit easier in those returns to their investors. Or they go out and purchase promissory notes from other investors, and promissory notes, as we all know, are basically mortgages from that other smaller investors might do. What is it called? Owner financing. Well, I couldn't even think of the term. So you do owner financing, you create a note, and then you could sell that to another fund that only purchases promissory notes. Fund managers have a pretty massive competitive advantage, in my opinion, because they have the cash on hand. And so whereas syndicators have to go out, lock up that property and say, hey, Mr. Seller, let me go get the capital to close on this deal. And trust me, it happens every single day, particularly with large commercial real estate. But there is also a competitive advantage with cash because every seller loves cash. I mean, who doesn't love cash? When you show a seller a bank account, exactly like Jeremy just said in the chat, whoever has the cash has the rules. And that's basically, you know, the way that it is. If you got a seller of a particular asset, you get two offers. One, hey, I'm going to go get the cash, or another one, hey, I have the cash. You could rest assured that the guy who has the cash is going to receive some extra points from that seller. For as long as we've been doing this, that's the way that real estate has always worked. And really, actually, if you're buying anything, business, even if you're buying a car, you show up to the dealership, you get preferential treatment if you show up with a big old suitcase full of cash versus, hey, what is Ford, you know, what is Tesla offering on credit terms these days? We got to respect the Tesla community. We love Tesla too. Any questions? Yes, exactly. The golden rule. Any questions so far, team? Please fire it off. We are speeding through this and the topics are flowing off nicely. I want to make sure that we are not leaving anyone behind.
Yeah. So, well, basically what Hector is saying is that the sponsor will start raising the capital with the business plan. Hey, we're going to invest in single family homes in the South Florida area, you know, so this is our track record. Usually the sponsors have a good track record, have a great education, has great experience. And this is what we've done so far. Do you want to join in? If they do join in, then when you got all that pool of capital, so it's not the same thing saying that you're going to buy a home when you have $300,000, or you go, hey, I'm going to buy a home. I got now $2-3 million. You want to give it to me? You know, then you have the power of negotiation. Not only you have the power of negotiation, you have the power, okay, I don't like this one, I don't like this one, don't like this one. Or you can just sit and whenever a good opportunity shows up, the cash is there to pounce. Okay, that's the beautiful thing about those blind pool funds. Okay, and like Hector said, it's very easy to diversify in a sense that as long as it's in your business plan, I'm buying single family homes or I'm going buying homes in the Southeast United States. You can go to Florida. Florida had a hurricane. You can go to Georgia. You can go to Tennessee. You can do whatever. And you can just pick and choose and you can find the best deals because the fund is open enough for you to pick the locations and the properties that you want. Also, depending how the blind pool fund is set up, you can buy pretty much everything as long as the business plan indicates that you can do it, and you're not allowed to change it after. So usually the blind pool funds, they have a business plan that is fairly wide open. So hey, it shows up here, a whole bunch of fourplexes. Well, I can buy properties. That's it. So let's go and hit those fourplexes. If you got something very like the specific funds, then shows up the fourplexes, like I cannot do that because my fund doesn't allow me to. All right.
Exactly. And
So-
actually, one more golden rule, Mr. Woodshed Williams says, the one with the gold rules. I love that. I like that one. I like that one a lot. And so, again, there is the specified offerings, the syndications are done every single day, team. They are mostly for the larger commercial transactions that you should not, and makes it harder to raise in a fund because you don't want to sit on, let's say $10-20 million waiting for a deal. Unless you have access to deal flow that you could place that $10-20 million very quickly, you're typically going to syndicate those sizes of deals. Because they take a little bit longer to source, they take a little bit longer to close, unless you have massive deal flow and you're a big player and you have access to $50 million deals every day. You should not go out and raise a fund and sit on $50 million until you come up with a way of sourcing it. That one you would go with a specified offering, you would find the investment and then bring it to your investors. I hope that's making sense for everyone. And then we're going to go ahead and move on to the semi-specified offering, which is essentially a hybrid of those two methods. You want to run us through that one, Lou?
Absolutely. So the semi-specified offerings are, like Hector said, it's a hybrid. It's a mix of both of them. Okay. The sponsors go and find a property and they can start, because it can be done both ways. They can start as a specified offering for a certain property. But then, since that property is performing really good and they really like it and they know what they're doing, it's like, you know what, let's keep raising money. And because another one just show up and another one just show up and another one just show up. So in the specified offering, what's going to happen is you're going to have the pro forma for that property and you're going to have a business plan. This is how we're running it. And then what we're going to do is you got that first property, that's first asset, and then you're going to go and boom, start pounding for the next one. And then the next one, then the next one. So you can keep raising money before the first purchase. Once everything's settled, okay, let's look for the next one. And you can keep raising money. The key here on the semi-specified is that the asset specific. So if you're buying Walgreens properties, like that you just for Walgreens places, that's all that you can do. If you are doing, RV parks, that's all that you can do. You're not gonna go get an RV park and then you can go do something else. So usually the semi-specified, they begin as a specified offering. Well, if we're doing this, why cannot we follow it? And they use the same paperwork, the same everything to, keep the ball rolling. The next one is a segregated offering, okay, which is another type of hybrid of the first two. In the semi-segregated offer, here's what happened. Everything goes through. I messed it up.
You got it. There you go.
No, because I got the chat in front of it. Okay, so in the semi-specified segregated offerings, what happens if you just imagine a big umbrella, in the sense that you raise capital all the time. You keep raising capital, and it's like you say, it's a hybrid. It's very similar to the blind pool fund, but you create separate entities. Just imagine a big umbrella where you just created a little fund, because we're going to invest in homes in the Fort Myers area because, let's buy from the people. Then you got another different fund that is going to be just for RV parks in the Fort Myers area. Then you're going to say another one that we're going to buy is tiny homes in Tennessee. And the difference here is that each one of those funds, they do not have any relation to the other. So the investor, again, the sponsor is the big one with the umbrella, and he can show the investor, okay, we have this and this and this and this and this. Which one do you want to get into? and the investor will make a decision.
Are
Those
you saying it's
funds
like a
will not-
buffet of investments?
kind of in investments. So you get a good portfolio of this is what we're doing. Where do you want to be? The beautiful thing with them is that each one of them are not related to the other. If one of the asset classes crashes for some reason, you are not involved in that fund. If one of them goes great on the other side, you're not involved with that fund. You are involved. The only common thing there is the sponsor. Okay.
That is correct. Gregory Hill says, go ahead.
Yes.
You got it.
Gregory says that it sounds like it's a good way to diversify inside of the real estate umbrella. Absolutely. The only common thing here will be the same sponsor. If you trust your sponsor and they know what they're doing and they got proven results already, why not do it? You are diversifying because you can diversify in the geographic area. You can diversify in the asset classes. You can, diversify in every single thing as long as you have a good relationship and you trust your sponsor.
And we could probably relate this to the stock market relatively easy, right? So again, BlackRock, there's a bunch of other hedge funds. Charles Schwab has a bunch of hedge funds, and you might be in 3 different Schwab funds. And you don't make money if you're not in the 4th one, if the 4th one goes up. But the whole time you're working with Schwab, let's say, as a prime example here. And this is even in the days of the Invitation Homes and the other different funds that were buying single family homes back in the 2015, 2019 era, and even still today, they're still buying really heavily. A lot of those guys like to segregate by either geographic or by year. Hey, this is the fund for 2022. This is what we bought for 2022. Gregory, do you want to invest in my 2022 fund? You're not going to make money off of the 2021 if you didn't invest. But you're also not going to lose if that one loses, in the same scenario. So it does offer its great value in diversification, and it allows you, once you already have a relationship established with your investors as a sponsor, it allows you to continue to put them in various vehicles. And this is actually a great model used by a lot of the larger offices, because they themselves want to be diversified, right? I don't just want to invest in single family homes. I want to invest in multiple different asset classes. So the best thing for me to do as an investor, as a sponsor myself, is to bring these different asset classes to my investors. Now we're both diversified.
Absolutely. Any questions so far? Type 1 if in the chat if you have any questions. This is a lot of, Gregory has a question. Go ahead. He's typing in a minute. Okay.
We're going to get there, Greg. We got it, man.
Wait. Two more slides. 2 more slides.
Patience, Grasshopper. We're coming. And then we're going to touch on that one as well. Okay, so that we say this because we got feedback on this last time. Gregory asked 2 questions. How do we get access to these offerings? And what is the minimum amount needed? We're going to cover that in a couple of slides. We didn't have the second question on there, but we will definitely add it.
Yeah, it depends basically on each fund. Everybody has their own rules and whatever they're looking for. Any other questions about what we've discussed so far? Type 1. Is this being recorded?
Sir, it is being recorded. Absolutely.
Being recorded. Every time we go in the air.
Hopefully, I did it right. It shows that it's recording on top. So
I don't see it here. Yes, it's recording. He's in the cloud. You got it.
Absolutely, and obviously, we're always here, guys.
And Greg, if you want, send me, DM me your email, and I'll send you the slides and everything. So so you have them.
All right, Luis, the next massive question that we all have is what? Why invest in a syndication, right? So why would I want to invest in a syndicate? And obviously, as you all know, this is no secret. I love real estate, and I'm a firm believer that real estate is the best, if not the most entertaining way of creating and passing on wealth, that generational wealth that I'm constantly bringing to you guys and that I'm constantly talking about. It is my firm opinion that real estate is the absolute best way of making it keeping it and passing it on to your kids. So that's absolutely one of the main reasons why I invest in real estate. And obviously there's about 6 million other reasons, right? Let's run through them. Cash flow, tax write-off, hedge on inflation, which is massive right now. I get it. Inflation is somewhere around 8%. But if you look around the country, real estate, especially residential, is up 20+%. Go ahead, Lou.
It's 20, residential is 20, 22, 25%, depending on the region of the country where you're at. So even if
inflation,
you killed it.
We absolutely killed it in terms of residential real estate. And so that absolutely clearly worked. Historically, it is slightly more resistant to downturns in the economy as well, when it comes, compared to the stock market, and access to leverage in the form of debt and bank financing, which is, absolutely one of the best known non-secrets about real estate. You can get a bank to loan you upwards of 70-80% of your purchase price, which is amazing. It goes a long way. And there's really two basic ways. Obviously there's more. We talked about the REITs and the different ways, but there's actually two basic ways that are my favorite ways of actually investing in the hard asset of real estate, not just shares of REIT. And that is to, number one, build your own portfolio of properties, which I absolutely advocate for. I'm constantly on here letting you all know that you should be buying real estate, whether it's commercial or residential, but you should be building a portfolio of properties. Say you don't want to do that because you don't want to create a second job or a third job for some of us, and now having to manage this portfolio. And regardless of how passive anyone tells you owning property is, it's still, you still have to babysit the property manager. And if you own the property, you are the asset manager. So you have some sort of involvement.
That's right.
The other way to go fully passive is to invest in syndications and real estate funds like we're talking about today, because there is a sponsor or a manager that's going to, a general partner that's going to take care of all of that asset management for you. So therefore you are truly passive. Your one job is to vet that sponsor. Then from that point forward, you sit back and you go to the calls if you want to, or you just review your statements that you're typically going to get either monthly, quarterly, or annually, depending on the particular syndication. Taking the passive route gives you yet one more form of leverage on top of the institutional lender or bank financing that the sponsor might decide to leverage that particular piece of real estate. You're now leveraging that sponsor's experience and education, which it's obviously one more way to diversify. Now you can invest in multiple asset classes without that massive learning curve. And some asset classes in real estate do take you a little bit to understand and to figure out. Some things like residential real estate, buying a condo, buying a house might not be as difficult. But, when you get upwards of land plays or certain triple net leases and sort of multifamily, it requires a specific set of skills that you either going to have to go out and get and pay for that education, or you're going to leverage a sponsor who's been doing it hopefully for a while and who has that education and that experience.
That's right.
And most, obviously not all, but at least all the particular syndicate models that we're mentioning here today give you ownership over the title holding entity. So you get all the same benefits as you going out and buying that property. It's not just your capital now. So you're buying a much larger capital, a much larger property, sorry. And that then the ownership gets split evenly depending on your investment on that particular syndicate. You own that piece of that property.
Yes, you own a little piece of the pie, and your benefits are proportionate to what you put in the fund. So obviously, let's say you put a little bit amount of money, there's depreciation, everything. If you are high income earner, you will not be able to get the full depreciation or get the full benefits. It goes by the size of the pie that you invested in. Okay.
Exactly. And now we are not CPAs, but Luis and I both know plenty of high income earners, doctors, lawyers, people who have W-2 jobs that make heavy into the six figures, and they offset most, if not all, of their taxable income using real estate in one way or another. There's a lot of tax strategies that real estate can afford you. And this is and investing in syndicates and real estate funds is just one more way that you can go after those. And just a little one to mention is that sponsors do have a fiduciary relationship to their investors. So they do have to put your well-being above their own. So that should give you a little bit of peace of mind when you're investing in a syndicate, knowing that this manager, it's not much different than the board at Twitter. We've all been watching the Twitter fiasco with Tesla and the back and forth, and the board has a fiduciary relationship to the shareholders to make sure that they choose the option that is most beneficial to the shareholders, not to the board, not to the CEO, or any one particular member of management. Their main goal is to protect the shareholders, and that's this very same case when you are a sponsor or a GP of a syndication or a real estate fund. You have to protect your investors first and foremost. And if we don't have any questions right now on that particular topic, we are going to go ahead and move on to why do you want to create a syndicate, Luis?
All right, so here's the other part of the coin. Let's flip the whole thing. We already told you why would you like to invest, but let's say you already have some, experience in real estate and, flip a couple of homes and, what else is there to grow? So we're not going to go too much time in this, but remember, use this the way for you to share your gift to others. If I'm good doing something, I want my family, I want my friends, I want to bring them up, I want to bring them with me so we can all grow. So technically, what it says in the slide, you will capitalize on your skills. I'm really good at flipping homes. So instead of going one by one by one by one, okay, let's grow this business. How do we grow this business? Using the old tactic from beginning of times, is using OPM, others people's money. The legal way to use other people's money is to create a syndication. Okay, if you go around and you go asking for somebody to lend you this amount, and some other friend this amount, and some other friend this amount, and you just buy all that money, you are prepping yourself for having a big trouble if your deal does not go through properly. We were told not to do it anymore. We did it in the past. We were really lucky that we were very successful and profitable in pretty much each one of those that we did. And we saved ourselves the trouble. So now our attorney is just said, just do it the right and legal way. So how do you do it? You grow exponentially. How do you grow exponentially? Because instead of having enough money to buy a house, a home, fix it, flip it in that time, you get the funds, you get pretty much infinite amount of funds depending on your capacity of raising that capital, and you can just start churning, the ball or doing a snowball effect. You go a little bit more, a little bit more, a little bit more, a little bit more until you got a big chunk of money. Where we already discussed in previous slides that having the cash at hand lets you make decisions, puts you in a more favorable way compared to other buyers or to other sellers. So your growth is faster and exponential. Every other business, we're not talking just real estate, pretty much every other business uses external capital in order to grow. There's no limit how big you can make it, okay? As big as your capabilities are and as big as your education and your own, growth.
And your own mental limiting beliefs, realistically speaking. You are, and a syndicator is only held back by their own ability to grow their team and their mental game.
Correct. All right. And if you don't think it's true, Hector has a whole bunch of examples here. But we can mention former President Trump. He's an awesome believer in syndications. We heard in the news, that he doesn't pay taxes, that he does it legally. It's there. Grant Cardone, Warren Buffett, Roger Kiyosaki from Poor Dad, Rich Dad. They all very awesome believers in syndication. Use other people's money to leverage your gifts. That's basically what it is.
And we'll throw our favorite here for all of us stock market lovers, Warren Buffett. while it might not be your traditional real estate syndicate that we're discussing here today, it is not much different. Mr. Buffett uses OPM, investor capital, to bring into his company, and then he goes out and invests it in following his business plan. Obviously now Berkshire Hathaway is a publicly traded company, but it wasn't always that way. He started with friends and family and grew and grew and grew until the massive monster that it is right now. That it gobbles up, I don't even know how, I think like 10% of Apple at this point he owns. It's quite insane what he's been able to accomplish using this mentality of sharing his gift and involving his peers around him.
That's right.
And that is I think some of the best reasons why why we create syndications and why we do group investments.
All right. So now the chat is popping up on the next most important question, which is that if we show you the whys, if you show you the because, and we show you, I think it's, the meats and potatoes of this thing, it's how.
How to invest in syndications. First and foremost, you want to determine your investment goal and identify your preferred asset type. I just mentioned a few minutes ago that syndications are a great way for you to diversify amongst various asset classes, but like everything we do in life, we should start slow and then move on and progress. You want to pick your preferred asset class because of whatever reason. Maybe it's you understand it better. Maybe you've had single family rentals and you want to invest in syndications and single family. Maybe you own some triple net leases and maybe you own some triple net leases and you know how they work, so you want to invest in triple net syndications. Whatever the case may be, start with something that's near and dear to your heart, and then from there expand and diversify into more stuff. Woodshed says he hopes that Luis is not syndicating into any tech buildings, and no, he's not.
Absolutely not.
Tech is not his strong suit. Oh, that was awesome. I love it. And so then once you've kind of figured that out, now you want to build relationships with syndicators that practice in that particular asset class. Just like Woodshed said earlier, a lot of the investing in syndications comes from your relationships with these syndicators. Not always, but a lot of times that is the best way to make sure you have access to the most amount of syndications. Some of them you see people advertising on the radio and on Facebook, but a lot of times these are not advertised at all. And let's face it, you want to know who you're putting your capital with and you want to have a relationship with them. So that is, I highly, highly recommend that. I'll give you a few tips on how to network and how to meet these syndicators in a couple of minutes. Another way is crowdfunding websites, right? Those sometimes work. So, sometimes they give you a lot of good investments right there on the crowdfunding website. They just have a little bit different rules, so you want to make sure you understand which crowdfunding website you're using, and at the very least you can meet some syndicators from there and then try to reach out. Now, full disclosure, the syndicators that are on these crowdfunding websites are typically the larger guys. Most of these websites don't allow you to go in there unless you've done a very substantial amount of deals and you've been doing it for a very substantial amount of time, and they are not always specific to the business model that we mentioned here today, where you actually own shares of the actual real estate that they're investing in. So you want to make sure that you know which one it is that you're going after. But my favorite way of meeting syndicators is networking. There is a million and one ways of meeting syndicators. Syndicators usually have podcasts. They have real estate shows, just like this one. Hint, hint. And they all go to a lot of national events for syndicators. Why? Because they go there to learn. They go there to network with other syndicators to see what's going on. And you always see in these events, again, for whatever asset class you're looking for, there is events for multifamily syndicators. There's event for storage facility syndicators, triple net syndicators. There's events out there that you can find, and you can go out there and meet these syndicators, connect to them one-on-one, break bread. Like Woodshed said, you never want to go with someone you don't know at all. That's exactly what we're alluding to here. Like I said, podcasts and educational programs are typically put on by industry experts. So befriend them. You hear somebody with a good podcast, they're in your local hometown, or you see them on the internet, try to get on that mailing list.
Reach out, yeah.
Reach out, just say hello. Trust me, they're never going to be upset because you reached out. That's the reason why they're putting themselves in a Paul forum. If you hear an awesome real estate show that goes on every month and you like those guys, call them, get on their list. There's also a lot of IRA administrators, self-directed IRA administrators who put on seminars for and with these syndicators. You can learn a lot in these seminars because yes, you can absolutely use your IRA to invest in real estate, but you could also use your IRA to invest in syndications. So you talk to a couple of self-directed IRA administrators, see what kind of events they're putting on, see what kind of webinars they're putting on, participate, see if you connect with any one particular syndicator that they bring on. The basic precaution that I will give you all here is you are responsible for conducting your due diligence on the sponsor. It's not much different. Actually, it's a little bit less labor intensive, but if you were going to invest in a particular piece of real estate, you would do your research. You would underwrite that real estate. You would look at everything that it entails to be in that real estate. Then you have to also manage it. Now, if you invest in a syndication, you don't have to worry about the management side of it, but you are responsible for making sure you know who you invest in. There's a massive difference between Bernie Madoff and Grant Cardone. Huge difference. I mean, we see Grant Cardone all the time on TV, and we know him.
And Bernie is not available no more.
And Bernie, I don't know if he passed away. If he did, rest in peace. But I do know that he was much older and he was in jail for stealing everybody's money, creating funds. Now, I think he was investing mostly in the stock market. I'm not really sure. I did not follow the story that closely, but it was brutal. So make sure you understand who you're dealing with. Make sure you understand what kind of due diligence, what kind of experience that team has. And your job is to investigate those people and make sure that you are comfortable with them managing your money.
And another
I would always suggest you, like with any investment, there's a risk, right? Invest money that you can afford to lose. You don't want to go out and take a HELOC out to invest in any kind of investment, and definitely not a syndication. Keep in mind that typically, like I said before, these are 3 to 7 to 10-year investments, and your capital is locked up in there. These are not liquid instruments that you can go out just and sell on the open market. This is not a REIT that you log on to your broker and you go, market sell, gone, your cash is liquid in your account. Doesn't work that way. It is fairly difficult to sell your interest in a syndication. I'm not saying it's impossible, but it's not the easiest thing. So make sure that you invest what you can afford to lose. As always, I always say, it is very, very important to have your experts in your team back you up. Contact your financial advisor, your CPA, your attorney. Get them involved in that process when you're reviewing that syndication prior to you subscribing and sending out your capital, obviously. Make sure that they agree, that they feel it's on the up and up, just like you. And like always, and like I mentioned, all investments have risk. So you should absolutely be aware of what those risks are. If you have any particular sponsor that sugarcoats it and paints it all beautiful, 2 warning flags. Like Luis said, somebody hounding you for cash, or second is someone who tells you there's no risk. This is a home run. This is a done deal. It's never going.
Oh, no.
All investments have risk, even Apple, guys. We've all seen Apple take a pretty substantial drop over the last few weeks, and it is probably one of the largest companies in the world. Balance sheet, they're sitting on trillions of cash. They're still taking a tumble. Even Mr. Warren Buffett's Berkshire Hathaway has taken a beating in this market. Every investment is susceptible and has risk. So anybody's telling you that there's no risk, run the other way.
Exactly.
That's not the person you want to invest with. Lou, what do you got to say? And team, throw your questions in the chat pane. We got about another 10 minutes before Mr. Yates Craig jumps on. So please fire off your questions and don't be shy. We are here to answer.
I would like to say another thing. Usually good sponsors will have reports, will be, willing to show you what they've done. They're proud of what they accomplished. So those people that they're not sure, or they don't want to give you paperwork because, it's private, again, shy away from those. They basically, sponsors are going to be trying to show off to the investor, and just, between the showing off, you will see that some of them are doing, good investment, and they're giving their partners good returns. Okay, so those reports will be great to have and look and evaluate. Basically.
Correct. And basically, and a lot of times you will find these as a track record, right? They call them a track record. Sometimes it's in the property package if it's a syndication. Sometimes if it's a fund, it's in the investment summary. And sometimes it's just a separate piece that investors give you all together. Like we said, there's a lot of sponsors and syndicators that go out there and just make relationships, and they're raising capital without necessarily having a deal. They're just building relationships, and that's when they're showing you their track record, and they're giving you information as to all their past experiences. And so that's very, very, very important. You don't want to invest. I think we talked about this before, a sponsor that's only done tiny houses in Alaska and is now going to go buy a farm in Chile, South America. And yes, there are funds and there are syndications that invest outside the US, but you understand my point. Let's make sure that you're investing with someone who knows that particular asset class that they're driving you into. Mr. Gregory Hill asked, what kind of cash do you need to participate? What is the minimum investment? And Gregory, that highly depends on the particular investment and the particular sponsor. All sponsors get to pick that. That's kind of up to them. Industry standard is typically going to be anywhere between 35 and above. You have some that go for minimum 100K, and you have some that go minimum 50K, but the most I would say are going to be somewhere between 25 and 50 as the base minimum. It's not something that's set in stone, is just up to the syndicator. There is additional costs and additional requirements that goes into an additional management to have a massive amount of investors. So if you have a syndication that's trying to raise, let's say $10 million, they might have a higher minimum because they don't want to have a gazillion investors. But if you have a syndication or a fund that's raising $1 million, their minimum might only be 25. Does that make any sense?
Yes.
Perfect. All right. Any other follow-up questions?
All right. So let's say something. Type 1 if this has been useful for you guys. Gregory, so one, couple of ones, a bunch of ones. Amazing. So Hector, where do we go from here?
All right. So you all heard all of our point of view and basic information today on what it is to do private offerings and what a syndication is, what a fund is. And we wanted to make sure that you guys had that very basic understanding. Next month's show, we're going to bring up a friend, a mentor, and our real estate, our SEC attorney, Kim Lisa Taylor. She's going to come on and she's going to take a little bit more of the how to raise private capital legally. In fact, that is the name of her Amazon best-selling book. And she also has a podcast, Raising Private Money Legally. So she's going to be on next week talking more of the legal aspects, some of the things that we didn't really get into, and how you yourself could put together a syndication. And I think I said next month. Sorry, that is October 28th. Friday at 2 p.m. Same amazing
last Friday of the month.
Last Friday of the month. And as I said, she is very good at showing you all the legal aspects of it and how to raise capital legally. So she's going to take that side. And even if you're saying, hey, I don't want to be the one that does the syndication, it's still something good for you to know and hear, so that if you're ever going to invest in a syndication with a syndicator, you know if they're doing it legally or not. So
what to look for, what to ask.
what to look for, what to ask, and all that good stuff. Woodshed says, what size projects are typically available in syndications? And which that highly depends. It goes anywhere. You can see syndications as small as $500,000. That second question is something better for us to talk about offline. But essentially, and I'll reach out privately on Slack, Woodshed. It's a cost thing, right? It is not cheap to have an SEC attorney draft all the documents and create all the paperwork that is needed in order to put together a private offering. So it just does not make sense for most investors and to put them together unless it's usually the industry standard is like over $500,000 investment. You're talking anywhere between $15,000 to $35,000 to write up syndication paperwork.
Gregory's asking, I think we're looking at decently sized RE correction, real estate correction. How much of an impact will this have on syndication projects?
It's a great question. I love it.
That's a great question. It will depend. It will depend on syndicators. Usually syndications, they buy the properties, for example, rentals. They buy the properties, they've been buying properties for 2-3 years, and usually the turnover is 5 to 7. So let's say real estate has a big dip within the next 2 years. They still have 2 more years or 3 to make up for it, okay? While they're still providing cash flow for the investment. So it will depend.
It depends on the syndication, exactly.
Yeah,
so,
it depends how smart they were buying too. If they were buying basically off the street, they were paying retail price for properties. They were paying wholesale price for properties. I just want to go through example that we're looking at Invitation Homes. Invitation Homes was buying and snatching everything that they could in the foreclosure auctions for 3 or 4 years
in a very tough market, and what everybody considered the worst real estate market.
Correct. And even if then at that point the market turned on them, they were still buying properties 30 to 35%, 40% of the retail price at the moment. So it depends. It really depends on
the most important thing,
and
Greg, there is to identify what kind of project it is. And this is why I said one of the more important things that you want to make sure is that exit strategy makes sense. If you see a syndicator tomorrow saying, hey, I'm going to buy whatever, let's say single family houses, and my exit strategy calls for exiting in 6 months. Well, that might not be a great exit strategy as a rental. Let's say in 1 year, or let's say that you are talking to a multifamily syndicator, and I do this all the time, right? I look at all types of syndications, and I get offers all the time to invest and co-invest and participate in many deals. And there's a lot of syndicators out there right now doing 3-year turnarounds, and they're looking at exiting with a lower cap rate and a lower interest rate, and they don't have a plan B. Oh, that's it. My business plan calls for exiting in 3 years. Well, what happens if rates are still higher and the market is still depressed and cap rates are actually up? So that's part of making sure that you understand who the syndicator is and what that syndicator's business plan is, and making sure that it's strong enough to weather the storm that's coming. When are they starting? Is their goal to purchase aggressively or opportunistically? And if you're talking in the case of a syndication that's buying triple net Walgreens properties, well, there's very little risk there to the real estate correction that may or may not be coming up due to interest rates, particularly because a lot of these things, are going to come with long-term debt and a phenomenal tenant that's, typically not going anywhere. Does that make sense, Greg? If you want, we can elaborate a little bit more before we pass the baton over to Yates, who is in the house.
Yes.
Awesome. Well, thank you so much, team. We really appreciate it. Again, we apologize for the technical difficulties. As always, please reach out, realestate@reallifetrading.com. If you're watching this recording on YouTube, make sure you hit that thumbs up button, subscribe so you can catch the greatness that RLT pulls out every single day. There's content out there. Thank you, Brandon. We appreciate it. We love you all.
Thank you, Brandon, appreciate it. Thank you guys for having us.
reallifetrading.com/RE for anything you want to know about Luis and myself, for all of our past videos. And if you ever want to reach out and just say hello.